thanks everyone for taking time today. It's certainly been a heck of 16 months here as we move forward with the COVID issues and everything that's happened in the marketplace. We feel extremely fortunate to have such great support at SIA Wealth Management, Inc., as well as our sister company, SIA Charts. It's been a tremendous year to highlight our technology, to highlight our processes across our investments at BMO Global Asset Management. So hopefully you're participating with all that. We're doing something a little bit different. As Jason mentioned, we're going to start to work some questions that we get from time to time from advisors like yourselves. So we appreciate you contributing to these questions. If you do them today, we will pick them up for our next one if they don't get answered on this call today. But some of the major questions that come up, one of them is, what is your opinion about the prospects of inflation going forward and the implications this will have on the markets, the economy, and ultimately the population at large? Certainly a very timely question. This chart here shows us the year of the bailout. And what inflation is being driven by is purely by central bank activities and government activities around the world. We can see some of the bailouts that have happened historically from 1970 right up until the COVID-19 bailout of 2020 and continuing into 2021. We can see how enormous this bailout was relative to others. So this is just a function of too much cash getting into the markets. There's statistics out there that for every dollar that was lost in earnings within Canada, $3 was replaced by the government in some types of grants or monies applied back into the economy. So a tremendous outspend to get us over this hump within COVID-19, and there's more on that later, but a significant change from where we've been historically as we looked at bailouts. So one of the charts, the chart on the left here, this is the 30-year yield in the US. We can see at the start of the red arrow going down, this is where we were pre-COVID. So we're already in a declining situation with interest rates at that time, but well within historical norms. We had a quick drop to sub 1%. This is a weekly chart that is showing here. So we even had a drop below that on the yield, and we can see now that it's crept up very aggressively since August. So since August of 2020, we've seen the yield rate going up, and this is a function of the market in the bond market showing us that interest rates need to be higher given what's happening. I think the most important chart, though, when we think of inflation and think of the risk of what's happened during COVID-19 is to look back and have some historical precedents and recent precedents I've highlighted here on where interest rates have gone, going all the way back to 1978. So as most of you know, in early 81, 82, we saw the peak in interest rates, and we've been on a steady decline for the last 40 years going forward. I've highlighted a number of positions within this channel because I think they're important and they give us some bearing on where we should be worried as we see yields rise as inflation may or may not become the evil devil that it could be. In 2008, we see whether we break below the bottom end of this trend here just briefly and just for a short period of time. And then we see it rally, the yields rally back up into 2011, where we start to poke on the top side of this. So in 2008, we went down below it, but quickly rebounded with this as we saw very similar activities that we saw now, just in smaller scale, quantitative easing and central bank and other central bank activities and government activities. In 2011, as we hit the top part of that range, we see the stock market start to act violently uncertain about it, and back to the bottom we go again. In 2018, we saw the same situation where we got near the top of this interest rate yield, and we saw, again, violent activity in the stock market, threatening and not liking where we were going as far as interest rate policy. In 2020, we ducked well below this trend, but we can see relative, given the size and the scale of the COVID-19 experience and the problems that come along with it, with the shutdown of economies, we've rebounded very quickly right into the middle of the range on this. So for my purposes and what I've been watching very closely is this yield is certainly escalating extremely fast. The speed of it is very important for us to watch, but I think it's what happens when we get near the top end of that range is going to be very important. The stock market has acted extremely negatively as we approach it. I would expect that to be very similar as we move forward and going from here. But it's certainly something to watch. And I think a lot of this can also be regional in nature. Canada and some other markets are experiencing inflation in areas like housing, which are dramatically different than even other markets out there. So we'll watch that closely. I think at this time, inflation is something that, listening to Joe Biden, listening to obviously the politicians around the world who have a lot to say, this is something that concerns them, and they feel that they can deal with it, and central bankers feel the same. So we'll watch that yield, and I think it's a good way for us to measure how effective some of these policies are given the spending that governments are doing. Global debt levels, so I think these fall hand in hand. Global debt levels are at all-time highs, and global central banks and governments have made it clear they don't intend to stop pumping liquidity into the market anytime soon. How does this end, and what will be the consequences of all this unprecedented stimulus? So I think it goes hand in hand with inflation. We can see now the public debt is now estimated at 57 trillion across the G7. So an incredible increase in debt. The debt to GDP has soared to 140% in the same G7. So this again is us moving further and further away from precedents that we've seen in the past and into those precedents where problems have arose historically. Canada and the US are among the top countries adding debt, but at least everyone is doing it. So if we look at that G7, for the most part, Canada is on the top end and the US is on the top end of this, and Japan, but everyone's doing it. So again, if we're playing this relative game, it's watching those money flows and how they're moving around. As Paul mentioned earlier, we're seeing more and more move to the commodities. Is this coming on the backs of all global economies getting back into traditional economic activity and demanding these commodities, or again, is this people hedging inflation? So inflation is going to be there, but what's different about this versus other times in history is that it's more unanimous across the board, with some exceptions. Global debt levels. So the interesting part about this chart here is this is the change in debt to GDP. If we look at Canada, we rank number 1 with an 80% increase in debt to GDP. I know many of us have heard statistics coming out of federal government and other institutions talking about the relative debt Canada has federally versus other countries around the world. But if we take into account households and non-financial corporations, this debt has risen dramatically versus any other country in the world. What we see at the bottom is Australia, which actually had a negative movement, and they had a novel idea instead of sending checks out as many countries have done, including Canada, they decided to allow their citizens to have access to their equivalent of their RRSPs for the purposes of keeping their cash flow normalized during this downturn without a tax consequence. So it was a novel idea. It appears on a relative basis to have dramatically improved their position globally versus other countries such as Canada, which has been essentially sending these checks out with no consequences to its citizens of any kind and increasing our debt load. So it'll be interesting to watch this, but for the most part, most of the countries that are important are at the top end of this curve. And if they're all going into debt at the same levels, I think Canada stands out as a much, much higher risk. And we probably see this in, again, as I mentioned earlier, some of that housing starvation that we're seeing as people rush to purchase homes. A great place to hedge against inflation going forward. So sustainability in these debt levels, it's hard to measure what we're seeing at what level this is going to have a crisis. It's a relative game. So from our side of the fence, we're going to be watching the relative activity of country versus country in their equity markets, because as these money flows continue to go, there appears to be nothing to stop them right now. Certainly within Canada, the United States, there is very few restrictions. There's not a lot of oversight coming in. We haven't seen a budget in quite some time. So very, very little oversight from the opposition parties in any sense to restrict this. We're going to see that going. This is going to stimulate the stock market. This is going to stimulate housing. This is going to stimulate areas such as commodities as people hedge against that inflation, and we'll watch that yield to see if it has any negative effect on it. I think a great question, market insight on green energy. What is your opinion about the green energy trend from both an economic and an investment perspective? I think it's what's really quite telling, the change that we've seen year over year from 2019 to 2020 from the International Energy Agency, is just the investment that went into different areas of energy around the world. Coal was reduced over 6% year over year. Gas was reduced over 3%. Oil was reduced over 8%. Nuclear was reduced over 4%. Total energy demand dropped by 5%, although that appears to be coming back on pretty good. CO2 emissions dropped by over 6%, so that's obviously great news for those who are looking to affect global warming. But this comes from more from the economies being shut down than any proactive activity. But overall, energy investment is down over 18% year over year, with renewables seeing an increase at just under 1%. So the amount of investment that went into energy of any kind is dramatically reduced. But what we saw come out of conventional energy was not replaced by renewables, was not replaced by anything that we can measure there. When we look at exchange traded funds, there's the iShares Global Clean Energy ETF. I think this chart's quite telling, because we can see for the most part since its inception in the latter part of 2008, which they couldn't have timed that, probably much worse, but we saw it decline dramatically and then consolidate for a number of years. So we've had this ETF around now for about 13 years with really no activity until we get into 2020. We saw the crisis in February, the initial drop on it, and it's been extremely strong since then. But on a relative basis, or on a strength basis over that 13 years, is still not at the level where it was on its inception date back in 2008. So it's quite telling. I think that most of the growth we've seen has just been relatively new. So it's too soon to tell. What we're seeing here is going to be something that's going to be sustainable, at least at this pace of growth in the stock market and the valuations of these companies going forward. The chart on the right is U.S. Energy ETF IYE versus the Global Clean Energy ETF, both iShares ETFs. We can see that since 2014, it's been extremely one-sided with energy collapsing. Paul Bendrinsky talked about that. Energy just by itself has been in a steep decline since about 2010. Commodities ranked very, very poorly in our asset class rankings at SIA since latter part of 2010, and we've seen the repercussions of that. What's interesting though, because of that lack of investment that's happened over the last 12 months, conventional energy is seeing a rebound relative to what we're seeing with clean energy. As Kyle mentioned earlier, we have been participants in clean energy investment, and we will continue to do that. It's an area there, but we've now moved into more conventional investing, and one of the reasons why is that relative strength between the two appears to have moved to the conventional energy side, at least for the near term. So from our measurement of what's going to happen with the green energy, as much as we all want to tackle global warming and address some of the issues with that, there's still a need for conventional energy, and almost by default, because of the lack of investment, the removal from indexes such as the major indexes around the world, that the investment and dollars going into energy development has been reduced dramatically, which may choke us off as we get through this transition. So we intend to, at this moment in time, continue to present a relative view of energy investing, which has moved from clean energy from the early part of this year now into conventional energy. So we'll watch that over time. I'm watching the clean energy ETF. I'd love to see that breakout above its 2009 levels and see that trend continue for a longer period of time. And I do expect that to be the case. It just may or may not take more time than some people think as we switch from conventional energy to greener energy in the years to come. The final market insight for today is these meme stocks. It's quite a situation, regarding the recent events surrounding Reddit, whereby the average investor was able to manipulate stocks like GME, GameStop, and AMC and push them higher, punishing professional investors who are short these stocks. Is this going to change the investment game going forward, or is this a short-term phenomenon? So the way we view it, we actually, when we're investing at SIA Wealth Management, we deliberately avoid these types of events. Our system is programmed, and our investment portfolios are to try to weed out these types of investments, which we did. We don't want to participate in short-term phenomenon. We're always looking for intermediate to long-term results with our portfolios and longer-term trends, and not getting messed up in situations of, well, this would fall under potentially market manipulation or a mania, which we have seen in the past. So anyone who's got as many gray hairs as I do in the industry saw the top end of that tech market and the mania that happened within that, which was essentially the panic buying and too much liquidity of that time frame in the technology market. So this is a little bit different. This is tremendous short selling on certain names, right or wrong on those positions on short selling. The Reddit investors, retail investors, work together to put a short squeeze on them effectively and raising the price of the stock from $4 to well over $400. So they achieved the goal they wanted. What will this look like going forward? Certainly the regulators and exchanges are likely to put rules in place to minimize this in the future. This was not a situation likely they would judge, in my opinion, where what happened in the price movement of the stock was something of a fundamental nature or had anything to it. And you certainly have evidence through the Reddit blogs that there was some collaboration between retail investors to have this short squeeze happen. So it's more of a mechanical and a functional way of addressing it. So from our point of view at SIA Wealth Management, we're not willing to participate in these. We'll try to endeavor, and our technology has been tuned to avoid this, because the risks that remain or could happen in these short squeezes could certainly be quite large. I'm expecting that those who were squeezed in this situation are going to take action as much as possible to not be squeezed again, but also to potentially reverse what's happened to them with retail investors going forward. And we also have a situation where a lot of the funds that are being used to do these short squeezing by small retail investors is coming from the government coffers through stimulus checks that are going out to individuals across the United States, Canada, and around the world. So we do expect that to change. But I think the biggest part is the regulators and exchanges clearly will zero in on this and make some adjustments over time. We'll see that over time. But again, we will avoid that at SIA Wealth from our point of view. So finally with that, send us your questions. Those are 4 questions that have come to us over the last month. We're going to tie these questions into market updates over time and give you those insights and hopefully talking points that you can use with your clients and with your peers to help better understand that. So please continue to send those to us, and we'll keep highlighting over time. With that, I'll turn it back over to Jason and see if there was any questions that came for any of the participants at SIA.
Great, thanks, Jeremy. And at this time, I don't see any further questions here for today's webinar, but please, as Jeremy mentioned, please send your questions in to us over the month. You can send it to sales@siawealthwm.com, and we'll be sure to compile them and send them over to Jeremy so he can address them for next month's webinar, which would be in mid-April. As a final reminder, please, at the end of this webinar, please take 30 seconds. We'd really appreciate it for you to respond to the survey after this webinar. We really want to make sure this is productive and useful for you. So if you could just take 30 seconds and do that, we'd greatly appreciate it. So until next time.
Sorry, Jason, one other note. I have been asked to do these market insights for our top clients at SIA Wealth Management. They're retail clients. It has been a source of successfully gathering assets from prospective clients as well as existing clients to get them to better understand how SIA Wealth Management and our true tactical strategies are effective in portfolios. So if you do want to do a retail presentation, please reach out to us and we'll do what we can to support that. And sorry, finish your thoughts, Jason.
Absolutely. And if you do want to do that, please, again, send us an email. You can send it here as well to sales@siawm.com, and we'll certainly get back to you as soon as possible on that. So again, thanks everyone for joining us today. We'll stop it there and have a great week, everyone. We'll see you next month.